Alright, guys, so today we're going to talk about real estate investing. So, with real estate investing, I'm referring to buying and renting properties. Let's discuss a little bit why real estate investing is a great option. Um, Number one, real estate is a very safe investment. That's my experience. That's the experience of many other people. You can research, discuss it with other people in your community, in your social circle. You'll probably get the same answer. It's a very safe investment because property values typically always increase. It would be a rare event if your property value decreases. So from that perspective, real estate investing is very safe. If you put money in real estate, you are always gonna get a return from it, a positive return from it. So that's why I call it safe. If you compare it to other investment options out there like stocks, cryptocurrencies, those are much more volatile, and you have to invest a lot more time in researching them, figuring out which stock is the best for you, which cryptocurrency is the best for you, and even then, you're taking a significant risk by investing in those comparing with real estate. So with real estate investing, uh, the most important factor or something that's most imperative is the location, obviously. So whenever you buy a property, make sure you are maximizing your investment potential by choosing a location that serves your target audience. So, for example, if you're um, gonna target young people, students, college going, university going folks, you should probably buy your real estate property or your rental property close to a school or a university because that's what's important to those folks, right? They want to be close to their place of education so their travel time is reduced and so forth. Uh, if you're targeting young people, people who are early in their careers, obviously they want to have a social life. They want a location where there's a lot of shopping, things to do, a nightlife. So you would probably want to be close to shopping, close to downtown, restaurants, bars, things like that. And if you're gonna want to rent to more mature people who are later in their careers or even retired, then your location would most likely be suburbs, someplace away from the hustle and bustle of the city. So that's the most important thing. Think about it, do your research. What audience are you gonna rent to, and then choose your location accordingly. Find a property accordingly. So how do you make money in real estate? Or by renting to other people. This is how I made my money, and I'll shed some light on it for you guys as well. There are actually two ways you're making money with real estate investments or rental properties. Number one is the obvious one, the difference between your monthly rent that you're receiving from your tenants and your mortgage payment that you're paying to the bank. For example, let's say if your monthly rent that you're receiving from your tenants is $2,000 and the monthly payment that you're paying to the bank is $1,500. uh, you're getting $500 of profit every month, which is your income. Now don't forget to factor in any maintenance expenses that you might incur on your rental property. Typically, you would at least uh, plan for 20% of your rent uh, for maintenance expenses. So, that's obviously the most uh, simple source of income that you're going to have, your uh, rent minus your mortgage payment that you're making to the bank. The other part, and this is the part that a lot of people don't consider, is the equity that you're generating in your rental property. So, what is equity? Equity is the difference between the market value of the property and the loan balance that you have to pay to the bank. So let's say you bought a property for 300,000. You made a 10% down payment, which is 30,000. So your loan balance is going to be 270,000, right? So your equity is your market value minus the loan balance. So let's say your market value is 300. That's what you paid for the property. So 300,000 minus your loan balance of 270,000. 30,000 is your equity. Over time, as you make your mortgage payments, your loan balance is going to reduce. At the same time, the property value is always going to increase, or a vast majority of the time it's going to increase. So your property value is going to increase and your loan balance is going to decrease, and the difference is your equity, and it's going to increase over time. So you can tap into your equity anytime by selling your property, um, even if you are not interested in keeping it anymore. So equity is the most easiest or overlooked source of income that you get from rental properties. Uh, Even if you're not making any money on your monthly rent, let's say your you know mortgage payment is equal to the rent you're receiving, so you're not really making any money on the rent, but you're still building your equity. So your loan balance is going to reduce as you pay your mortgage payments, and your property value is going to increase. So even if you're not making any profit on your rent, your equity will always increase, and you can tap into that. You can extract that out of the property anytime when you sell the property. That's how I made my money. And over the last few years, the housing market has been booming, and property values have increased exponentially. The last 2 years I made significant profits from equity, just based on the value of the property and how much it increased. So those are the two sources of income again: your profit from your rent minus your monthly payment, and then your equity. And then the other factor that is also sometimes overlooked is depreciation, because depreciation reduces your tax liability on the income that you're generating on your rental property. So, what is depreciation? So, depreciation is the reduction in value of any tangible asset over time. So, if you have a rental property, uh, for tax purposes, it's assumed that the value of the property is decreasing over time, or the usable life, I should say, of the property is decreasing over time. Uh, so any tangible asset you can think of, any piece of equipment, any piece of furniture, any building, for tax purposes, it's assumed that its usable life is reducing over time. So for a rental property, the usable life of the property is 27 and a half years, um, from a tax perspective. So you're able to depreciate your rental property over 27 and a half years. Uh, and you can take that as a tax reduction every year. So again, let's assume you have a, just take round numbers for simplicity. Let's say you have a property that you bought for 270,000, and your depreciation is 27 years. So 270,000 divided by 27, $10,000 is the depreciation you can claim every year on your rental property. So what that means is that you don't have to pay tax on the first 10,000 of rental income that you get from your rental property. So, let's say you're making $1,000 profit every month on your rental income, and your depreciation, on that property is 10,000. So over 1 year, you made $12,000 in profit, and 10,000 is your depreciation. So out of that 12,000, you can subtract 10,000. You don't have to pay any tax on that. You only have to pay 2,000. You only have to pay tax on the $2,000. So that really significantly reduces your tax liability and increases the money in your pocket. Uh, so that's a big benefit with rental properties. On other physical tangible assets, you don't get that much depreciation. With rental properties, you have this huge benefit. So that's another way you're making money on rental properties. uh, all right, so that was pretty much what I wanted to cover. So, as I've explained, rental properties or real estate investing is a great source of generating income. So if you can invest in rental properties, please do consider it. You won't be disappointed. And again, if you have any questions, please leave your comments at the bottom of the video, and see you again next time. Thank you.